Okay, in these next two videos, we're going to be looking at how we calculate equity. So you remember back some of the activities we did in class to look at how we calculate the Gini-Coefficient, and then what's meant by a universal basic income and some of the pros and cons associated with that. So starting from the start, the ABS collects different types of income to develop an understanding of how our economy is going and people's well-being. So to calculate income, we use a thing called equivalized household disposable income, and that's basically the disposable income divided by the amount of people reliant on that income in that household. That allows us to make comparisons between households to see what people's costs of living and people's living standards are like. So essentially, to calculate income inequality, it's done every few years by the Australian Bureau of Statistics, or the ABS, and it's for people over 15 years of age. But basically, it calculates 18,000 households from a cross-section of different households, so they don't survey everybody, and they survey about 0.2% of households and get statistics on their income and the amount of people living in their house and a range of other statistics. So step one, 0.2% of households are surveyed. That's what they do first. They go around and they survey 0.2% of Australian households. Then what they do is they rank their equivalized household disposable incomes from lowest to highest. So if you remember this lining up in the back of the room in class, you use the mean income for each group and they rank them all from lowest to highest. They separate them into 5 groups or 5 quintiles according to the bottom 20% or lowest income earners all the way to the top. They plot the Lorenz curve and they calculate the Gini-Coefficient. So they're the 5 steps, and we're going to explain each of them in more detail now. So first thing they work out is how to work out equivalized household disposable income. So basically, you don't need to know the exact formula, but basically what it is you get the income for the household and you divide it by the amount of people living in that house. But it's not divided by 4 if there's 4 people in the house. It's basically divided by 1 for the first adult, 0.5% or 0.5 for the second adult, and anyone else over 14, and 0.3 divided for anyone under 14. So for example, if you had a family of 4 with say two adults and 2 kids, and 1 kid was above 14 and 1 was below, it would be the total income, so that's $100,000 divided by 1 plus 0.5 for the next adult, so divided by 1.5. 0.5 for the child over 15, so that's 2, and 0.3 for the child under 14. So it'd be 100,000 divided by 2.3. So that their equivalized household disposable income would be less than somebody who had 100,000 with only 1 person in the house. So that's essentially how it would work. You'd 100,000 divided by 2.3, and you'd end up with a equivalized disposable income of 43,000, which is much less than what it looked like if there was only 1 person in the house. So essentially what they do is they work out the equivalized disposable income for all of those households that are surveyed, and then they rank them into 5 quintiles. So the bottom quintile, they work out the mean. So the mean, say, is 388 for the bottom quintile, and the mean household income is 2009 for the top quintile. Again, those figures have already been adjusted for the amount of people living in the house. And that essentially works out what quintile you belong to. So then what they do is they work out the percentage that of the total income that each quintile earns. So the bottom quintile, the bottom 20%, their average is 388. They look at the total income and they divide 388 divided by the total. So the bottom 20% have approximately 7.7% of the total income. Okay, the next 20% have around 12.5% of the total income, and the top 20% earn around nearly 40% of the total income. Okay, so what they do then is they plot a Lorenz curve based on what we call the cumulative percentage of the different households. So essentially what they do is they use this thing here where this is the cumulative share of the households, and on the x-axis we have each quintile, so the bottom 20%, next 20%, etc., etc. And then what they do is they work out, all right, the bottom 20% have 7.7%, so you plot a line there, and that's much below what we call this line of equality, which is if everyone had the same amount of income. So if the bottom 20% had 20%, the next 20% had 20%, etc., etc. Then what they do is they plot a line using the cumulative income. So this 20.2% figure represents the total income earned by the bottom 40% of income earners. This 43.2% represents the income earned by the bottom 60%, etc., etc. So essentially, the further this line is away from the line of equality, the more uneven the distribution of income, and the higher the Gini-Coefficient will end up with, which we'll talk about in a second. But basically, the Lorenz curve is a line that's plotted using the cumulative percentage of each income, 20% of income. Then we calculate the Gini-Coefficient. The Gini-Coefficient is a figure between 0 and 1, and it's used as the gap between all the area between the Lorenz curve and the line of equality divided by all the area below the line of equality. So it's this blue area here divided by this triangle that makes up all the area below the line of equality. Okay, the further the Lorenz curve moves away, so if the Lorenz curve was out here, then this blue area would be bigger and that figure would be closer to 1. So if you look at it here, you've got your Lorenz curve, you've got your line of equality. The area A is the area between the line of equality and the Lorenz curve. You divide A divided by A plus B, all the area below, and that gives you a figure of between 0 and 1. Okay, so it's area A divided by area A plus B, and that will give you a Gini coefficient of between 0 and 1. The closer to 1, the more uneven the distribution of income, because the Lorenz curve is further away and the blue area is bigger, and that will lead to a bigger Gini coefficient. Okay, so the Gini coefficient represents 0 to 1. You'll also see it represented 0% to 100%, but basically it's the same thing. A high Gini coefficient means greater inequality. If every resident of a nation had the same income, the Gini coefficient would be 0. And if one resident had all the income, the Gini coefficient would be 1. So the more inequitable, the higher the Gini coefficient. Okay, there's some Gini coefficients around the world. You can see Lesotho in Africa has the highest Gini coefficient, which means they have the most unequal distribution of income. They're the top 10 countries in terms of how inequitable their income is distributed. And then you've got some more countries that you're all aware of, like Australia, China. You can see it's more unevenly distributed in China. The United States have a more uneven distribution of income. And then countries like Germany and Norway, where the distribution of income is more even. Perhaps they have a more progressive tax system, or they give more generous welfare to low-income earners. So to summarise the steps in calculating the Gini coefficient, the ABS surveys 0.2% of households. They work out the equivalised household disposable income of all those households. They group them into 5 quintiles based on their equivalised disposable income, the lowest quintile being the bottom 20% and the top quintile the top 20%. Then they work out the median equivalised disposable income of each household. They draw a Lorenz curve, which calculates the cumulative percentage by each quintile. The further the Lorenz curve is away from the line of equality, the more unequal the distribution of income. Then they calculate the Gini coefficient as the area of A divided by A plus B. A being the area between the line of equality and the Lorenz curve, and A plus B, all the area below the line of equality. The bigger the Gini coefficient, the more unequal the distribution of income. Another thing you need to be aware of is the Lorenz curve for wealth. If you see here, you can notice that the bottom 20% had about 7% of the income, but they only have about 1% of the wealth, whereas the top 20% own around 62% of the wealth in Australia. These data is a little bit old, but it's relatively accurate. So essentially, wealth is a lot more unevenly distributed than income. And the reason for that is that wealth accumulates. So when we use the terms wealth and income just to start off with, wealth is a measure of your net worth. So it's basically everything you own. So all your savings, investments, you might have superannuation, cars, boats, houses, money in the bank. Mine is what you owe the bank, so mortgages and credit card debt. Whereas income is like your remuneration from working. So it's recorded on a yearly basis. It's like your labour. It's going to be like interest from the bank, dividends, profits you get from your business. So wealth is something that accumulates, where income is measured on a yearly basis. Examples of wealth: cars, money in the bank, land, furniture, clothes, all the stuff you own at a particular point in time is in your wealth. Whereas income comes like on a yearly basis. So it might come from owning a business, singing songs, having shares. Shares themselves aren't income, but you can earn income from shares through dividends and capital gains. Money in the bank is wealth, but the interest you earn on that money is a form of income. There's the distinction. The money you have in the bank is wealth, but the money you earn from that in interest is income. Your shares are wealth, but the dividends and the capital gains you earn on shares are income. Land and property is wealth, but you might earn rent as a form of income from that property. So types of income: wages, salaries, rent, welfares and pensions. So if you're on support from the government, fringe benefits, they're things like when your employer gives you sort of other benefits, like they might give you free holidays or a company car and things like that. Some people are on commissions because they sell things, so they get paid the more they sell. Interest, profits if you run a business, dividends, royalties if you sing songs or write books, and capital gains when your share prices increase or when you have property that you sell for a higher price than what you brought it for investment properties. So essentially, the distribution of wealth is a lot more uneven than the distribution of income. We'll talk about that a bit more in the next video.